It's like Bernie Madoff, who ran a Ponzi scheme, the largest ever, and he ran a great deal. Everyone thought it was the greatest, making these big monthly checks, never touching the principal. It's when they said we need the principal that we have a problem. The tight physical availability coupled with the massive delivery demand that is changing everything, because they're being asked to settle in actual metal. And that's something that never happened before, but it is breaking the system. The minute you stop and the consumer starts to rein in and, heaven forbid, save and pay down debt, the whole thing collapses.
But people are sleepwalking. They're absolutely sleepwalking. I mean, if I look out the window, so Andy, I mean, you're the expert on this as well. Why don't we talk about that, about silver prices surging, and the fact that this is, again, on the theme, one of the big themes in this podcast is about this scarcity versus paper world that we live in.
Yeah, well, and that's just it. I think, first of all, when you talk about silver, it's a tiny market relative to the capital that is and can flood into it. Excuse me. And when that happens, I think the move can and will be fast and probably very much disorderly in a market that has rehypothecated. In other words, sold the same shares over and over and over again, because no one ever stood for delivery. That's changing, and it's the delivery mechanism. It's like Bernie Madoff, who ran a Ponzi scheme, the largest ever, and he ran a great deal. Everyone thought it was the greatest, making these big monthly checks, never touching the principal. It's when they said we need the principal that we have a problem. You look at the LBMA. According to David Jensen, and that's the London Metals Association, the London Bullion Market Association, they have 2 billion ounces in outstanding spot contracts immediately deliverable against a 140 million ounce float. In other words, that float, those bars that are standing behind the contracts, in essence, are about 15 times outsized to the number of contracts. That's a problem. And that's what happens when you have a system that rehypothecates, or a paper system where no one ever stands for delivery. But I've been screaming for 4 years that the central banks are draining the exchanges. But in the last 15 months, it's been happening in the United States. Let me give you an example. To silver, in December, was the largest delivery for a month of December in the history of the COMEX market since 1974. The largest. 64,730,000 ounces of silver were delivered into the COMEX. It's called issued and stopped. Now, it doesn't mean it leaves COMEX. Some did. A good deal did. Doesn't mean that it's available either. That silver that was delivered into COMEX went into a non-deliverable category called eligible. And so far, just a half a dozen days or so into the new year, trading days, and we're already at somewhere very close to 35 million ounces of silver that has been delivered in a non-delivery month. So in the last 40 days, roughly 100 million ounces of silver has been delivered into COMEX. Now, that tells you the priority here. This isn't about paper promises, because less than 1% of contracts ever stood for delivery, ever. And now we're seeing massive amounts. And so when you talk about how this can change very quickly, yeah, I think you are witnessing a period of time where, paper promises are no longer demanded. And it is the tight physical availability coupled with the massive delivery demand that is changing everything, because they're being asked to settle in actual metal. And that's something that never happened before, but it is breaking the system. That's why silver is going parabolic. And I would simply say this: all you need to know is ask yourself, who in the hell is doing this? Who stands for delivery for 100 million ounces of silver, and why? And why have 8 Western banks held the largest concentrated short position in the 1,000 commodities traded on COMEX? Why is that breaking? Why supposedly have the US banks gone long? Who's bringing all this metal in? And if a mint box of silver Britannias or silver Eagles, 500 ounces in each, weighs about 45 pounds, who's taking possession of 100 million ounces? What does that weigh? And where's it going? And the point of it is that it's happening, and you can see this real demand for real metal that is going to create some very big issues. And I think that is why silver is moving higher. You got people on the wrong side of this trade that are being forced really to look into the mirror at an existential threat, and either they cover or they potentially get wiped out. And I think that's not hyperbole either.
Did you catch that? Banks are scrambling to cover massive positions because the physical metal is running out. This isn't just a trade, it's a historic squeeze. Before we dive into how this contagion spreads to the bond market, make sure to hit that subscribe button and turn on notifications. You don't want to miss what comes next.
No, I mean, for those of you who don't know and have had your head in the sand, silver prices surged by 80% last year. And actually, Andy, one of the interesting things, because we saw some similar squeeze on gold and the problems around physical delivery with gold. We were doing a lot of shipping of gold from London and other sources into the US during that tight period. Is that the COMEX, has kilobars. It relies on kilobars, and so So for instance, it needs to be in a specific form, and so there was quite a big trade that a lot of people were doing. Was taking their full market bars, those big James Bond bars, and having them refined and into a format that was accepted by COMEX. That's really never the kind of thing that normally goes on. So big problems there as that paper dam. Another example of that paper dam bursting. But the other thing is, I mean, the bond market. This is the seventh thing I wanted to talk about. The bond market is supposed to be one of the safest places in the world, certainly in finance. So, many people might be asking, why did it suffer a liquidity shock back in April? And I think you and I know the answers to that, but a lot of people don't, do they?
Well, no, I think that the bond market is really the root of all of this concern. And in an environment where we've suppressed interest rates for so long, assets like bonds have gotten completely and totally out of whack. Real price discovery is something that we haven't seen. In fact, I would argue the suppression of interest rates is what got us into all of these problems. Pushing interest rates down, suppressing the bond market, pushing the yields higher, but creating distortions in asset prices, in stocks, in real estate, in bonds, in everything that is a function of the value of money. And when you mess with Mother Nature the way that we did by suppressing interest rates, the entire West did for a very long time, to create an illusion of wealth in your 401k, in your home price, when the bond market tries to find some symmetry or some real value between asset prices and the environment that would actually call for higher interest rates, things get very, very, very concerning. And the Fed understands that if rates rise, the amount of indebtedness and the distortions that were created through decades of suppressed interest rates in asset prices is something that has virtually no political backing. No political backing. No one is going to stand for that. If rates were to spike, not only would your home price collapse, but your stock portfolio would, banks would collapse because they're loaded with treasuries, insurance companies are loaded with treasuries. This is what happens. This is why the Fed is trapped. This is why they are going back to adding $40 billion a month in buying more treasuries. This is why they stopped offloading the treasuries they already have on their balance sheet, the quantitative tightening, because they're trapped. And going back to the balloon analogy, it's like there's a tiny little hole in the balloon, and if you continue to pump air into it, 40 billion a week, it may stay inflated. The minute you stop and the consumer starts to rein in and, heaven forbid, save and pay down debt, the whole thing collapses. This is the problem you get by messing with interest rates, and the bond market is a function of that. Now you add into it weaponization of the bond market, sanctions, and tariffs that are actually sanctions masquerading as tariffs. You start to get less and less and less global demand for the U.S. Treasury. Another big problem. So this all comes back. We're trapped.
We are trapped. This is the critical point. The Fed has to choose between saving the bond market or saving the dollar. They cannot do both. If they print money, inflation kills the currency. If they stop, the debt market collapses. Listen closely to why this is a damned if you do, damned if you don't scenario.
You're damned if you do, you're damned if you don't. If they defend the bond market, why then, everything else collapses. If they defend, let rates go to where they're supposed to. the whole thing collapses. So it's a very, very, very scary thing.
Yeah, I mean, and I think people need to be really clear. In 2008, foreign ownership of US debt was about 50%, and that's collapsed to less than 30%. There's a lack of buyers for US debt because nobody wants that debt anymore. But that's what bonds are, by the way.
Which should mean that rates have to go higher because bonds get sold off, rates go higher, everything collapses, and that is. That is how it should be. So, but to defend the bond market, you have to suppress interest rates, which creates massive inflation. And that K-shaped economy we're talking about, and the Cantillon effect we're talking about, because if you save in dollars, your dollar goes less and less and less far to put basic necessities on the table. But, and that's
there's no political will for that.
Well, that's correct, and that is why the Cantillon effect is still in play, where the wealthy become exponentially more wealthy as their investments, their assets, go higher in an inflationary environment, but the dollar goes not as far. And a good way to show that is if you look at the price of a house in the United States 20 years ago versus today. The average price of a house 20 years ago was about $240,000. Today it's about $450,000. So your house nearly doubled. Sounds good. People would be happy, but so in dollar terms, your house went up, doubled.
Yeah.
But look at it in gold terms. Gold was $450 in 2005. Divide that into 250,000. You get about 500 ounces. So you could have used 500 ounces to pay off your house. You got 5 years left on your mortgage now. So you didn't. You stuffed it under your mattress, earning nothing but dust for 25 years, no interest. And here we are today with gold at 4,500 or 4,600. Those 500 ounces are worth $2.5 million. The average price of a house today, $450,000. It buys you 5 houses. So the point of it is that when you measure things in terms of assets, everything is decreasing in value. When you measure it in terms of dollars, everything is increasing. And that is why people get hoodwinked into thinking the dollar is safe because, well, it went up and it's great, it's great. But the dollar is what is depreciating, not the assets that we measure them in. Measure it in gold, and you'll see that to be true. Your dollar or your pound is like holding a melting ice cube.
Yeah, and this is effectively what we're talking about. Is the 8th thing I wanted to work about was the social cost, And, apart from housing doubling, you've got energy up 60%. You've got food prices up 40 or 50%. When money doesn't hold its value, long-term planning as well breaks down and time horizons shrink. So, inflation isn't just
This is the most important reality check. Your house price doubled in dollars, but priced in gold, it actually lost value. This is the money illusion. While you think you're getting richer, your purchasing power is melting away like an ice cube. Now, look at how central banks are secretly preparing for this.
Economic issue, it's a social one, and I don't like the world that we're entering. But listen, I know we're running a little bit out of time, and let's just double down again for those people who are maybe not as educated in this, the fact that if the dollar is supposed to be king, then some might wonder why we have central banks spending the last 4 years buying record amounts of gold. Other central banks have decided they don't want to buy these dollars. I think the gold has become the second reserve currency of the world, i.e. they hold more gold than they do euros, for instance, and they're buying more gold than they are treasuries. So central banks have purchased more than 1,000 tons of gold for 4 consecutive years. This is the flip. Gold is now the main currency they're buying, because gold is something where there's no trust required. Gold can't give you a tariff. Gold can't invade your country. Gold can't be printed. Gold is no one else's liability. It is the only real money. Everything else really is debt. So this is, again, a kind of movement towards settlement where you've actually got the real asset, it's yours already, and away from a world of complete counterparty risk.
100%. I couldn't say it better myself. Yeah, gold is an asset that is simultaneously no one else's liability.
But people are sleepwalking. They're absolutely sleepwalking. I mean, if I look out the window, people are 99% of the population, don't listen to our podcast. They are sleepwalking and they are going to fall off a cliff. And that's what I worry about. And I suppose that comes to really, if people are still listening, the strategy for 2026. I don't think it's about winning. It's not about speculation. It's about not losing, because this is a very fragile market, and the goal of 26 should be about making sure you don't lose it.
I agree. Look, and I say it again, simply, in the last 40 days on COMEX, we've seen almost 5 million ounces of gold delivered and over 100 million ounces of silver delivered in 40 days. Now ask yourself, the people at this level, 5 million ounces times $4,500, do the math. How many billions of dollars do you get? Or 100 million ounces of silver at $85, how many billions of dollars do you get? The thing of it is, as far as I'm concerned, Jason, is that you just need to ask yourself one question and understand this has been going on for 14, 15 straight months. At that level, the people who are doing this know where things are going. They do not do it just for the hell of it, period. And I think that what you are saying really is that if you save in currency, you're destined to go broke. And it's time to be a contrarian. It's time to think outside the box. It's time to look at gold and silver not as an investment or something that you hold only for chaos, but something that you hold to get out of the way of the debasement of the world's currencies, of the chaos that will ensue in the bond market should interest rates rise, especially where everything that is financial, stocks, bonds, real estate, are all inversely correlated to that moment. How does Glint play into all of this? What can people do to protect themselves with Glint right now instead of leaving their money in the bank?
Notice the shift here. Stocks, bonds, and savings accounts all rely on someone else's promise to pay. But gold? It's the only asset that is not someone else's liability. As we move into the final solution, ask yourself, is your money actually yours, or is it just an IOU from a bankrupt system?
Well, I think to summarize everything and to answer your question, Andy, if your savings depend on someone else staying solvent, and that could be a publicly listed business, or it could be, of course, a government-issued currency, then you're exposed. So how do you save in something which does not require anybody staying solvent? Well, of course, precious metals, gold and silver, are God's money. They don't change. Everyone talks to me about all the time as I go out and socialize. Oh, gold's going up a lot, isn't it? Silver's going up a lot. I'm like, no. Silver and gold are exactly the same as they were billions of years ago when they were created, when two neutron stars collided. You've got to wake up. You've got to take the red pill. It's the value of your currency that's plummeting. And of course, what Glint does, and what we set out to do after I had the idea after the last 2008 financial crisis, is to give everybody, everywhere, the ability to buy gold and silver at very small amounts. To democratize access to it, so you can buy gold and silver for as little as 1 cent's worth of gold. And this is real physical metal. This is not paper market we're talking about. You're buying allocated physical gold. It's in a vault that you own, backed 1-to-1, That's what you're buying. It's your gold. But then giving it something that normally people don't have, protecting their purchasing power, but giving them the ability to also spend it, because money is something you should be able to save and spend. So it protects you from all of the issues we've been talking about. You can put yourself onto your own personal gold standard, something that you can protect you from all of this systemic risk, protect you from inflation, but also spend it when you need to. You don't know when you might need to spend your savings. With Glint, you can spend it easily with the Glint debit card. And increasingly in different countries, you can also peer-to-peer, just send it to one person, another person who's got a Glint account outside of the banking system, outside of that risk, just from one app to another.
How soon before we get that in the United States, the ability to send money back and forth? And there's no cost in that, too. How long before?
Yeah, well, we're looking to have that up and running for the second half of this year. So we're getting ready for, of course, we've talked about it in other podcasts, we're getting ready for the implementation, execution for all of this US gold, state authorized gold and silver currency. And we're looking to have that all in place for June.
Wonderful, wonderful. What last things do you want to, what haven't we talked about? What last piece of wisdom would you like to impart upon the audience, and something that you think is big for 2026, maybe the most important thing to keep your eye on?
I think you've just got to wake up to the fact that the rules of money are changing. and that clarity is your advantage. I think you've got to become educated. You've got to be awake. And you've got to realize that when the black swans start happening, you won't have time to reposition. So you need to get ahead of that. And I'd say, Glint offers you the opportunity, Andy, to be able to get ahead of that. You can buy as little as 1 cent or 1 pence worth of gold or silver. There's no excuse for anybody not to be able to get positioned in this. Of course, we have people with millions or hundreds of millions of dollars on our platform, but everybody should be able to do this. And I'd say get educated, use AI,
The rules are changing. The old strategies of 60-40 portfolios are dead. What Andy is saying is that when the next crisis hits, the black swan, there won't be time to react. You have to be positioned before it happens. Let's hear his final piece of advice on how to stay ahead.
Lean into it. Get the productivity that it promises. Don't just leave it all to the richest people in society. Lean into it, but then see how powerful it is and how frightening that is as well to society. Watch the news. See actually what is happening here. This is pretty serious stuff.
It is for sure, and that's why I am an investor in Glint. That's why I use it myself. That's why I talk to people about it and recommend it through our company, which, if it wasn't something that I thought was very legitimate, something that had great utility, and didn't trust the people standing behind it like yourself, I wouldn't do so. Jason, as always, it's wonderful to see you. I know we're going to try and do this a couple times per month, and we really ought to. Just to have a conversation back and forth. I think it's very, very helpful for a lot of people who have questions that they maybe aren't asking, and maybe they didn't even know to ask. But this back and forth type of conversation, which is how I like it rather than scripted questions, is fantastic. So I want to, again, thank you, wish you and your family a very happy, healthy New Year. And I know I'll see you in person soon, but I'll see you back here, in a couple of weeks, and I look forward to picking up where we left off.